Yeah. All right. So what are your thoughts, guys? It's 5 o'clock East Coast time. Michael Batnick and I are live tonight. We're so excited to be here. We've got a full chat. Looks like Jay Luther is back. We haven't seen him in a minute. Todd Dennis is here. Bob Sacamano, 6'6", 626 is here. He said Josh was calming on TV today. Thank you. Maybe I shouldn't have been. Let's see. Matthew Stevick says Josh called today's bear market rally perfectly on CNBC with confidence. I appreciate that, Matthew. It's tough because so many people are in this mode that it's always going to be a V-shaped recovery, and the problem is they just don't know what time it is. When you're in a bear market, it's sell the rip. It's not buy the dip. So this is just situational awareness. I don't know what else I can say.
I'm buying the crash.
Heather McFarland is here. Rachel Fintwit, we see you. Roger, Mark Shevlin, James Sykes, Cliff. Love you guys. Great to be with you all tonight. We have a sponsor. Let's give Betterment Advisor Solutions a shout out before we get right into the show. That's our sponsor today. Imagining a better future is the first step. Investing in that future with Betterment Advisor Solutions is the next.
Whether you're launching your own practice, looking to streamline client onboarding, or just searching for efficient ways to scale your firm, Betterment Advisor Solutions is here to help. They automate to make tax optimizations simpler.
They provide support to make administrative tasks easier. At Betterment Advisor Solutions, they're building innovative tech for anyone who's ever said, I think I could do better.
So grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed.
All right.
Could say that again.
Yeah. All right. We're starting with stock market damage. Michael, take it away.
Okay. Well, before we, how are you feeling?
I'm fine. I think we're like all over this. Like honestly, I think from the start we said this is not just a dip. Then we said this is not just a correction. Like I think we're giving people the truth. It's not what we want to say. Like it's not what we want to have happen. But look, the number one thing here is that they're going to wipe out a year's worth of earnings gains, and they're telling you they're going to do it, and it's happening. And I don't know how you really avoid that. So once you know that that's what's happening, then the only place you could pivot to is, okay, well, what's the multiple?
Yeah.
And when this bullshit started, it was 21. And now it's still 18. And the long-term average is 16.5. So you're still statistically expensive. The Fed is in the penalty box. They can't come out onto the ice just yet. Ain't going to be no fiscal stimulus this time. The last time we had a massive recession threat, COVID, right? That ain't happening. And so you have an expensive stock market. You have a huge earnings wipeout potentially the longer this goes. You have all kinds of geopolitical shit thrown into the mix too. You got problems in the bond market. It's a catastrophe. So
yeah, but other than
why
that,
tell people it's not? Has been my attitude.
Other than that, it's pretty good. So you don't speak to me.
Wait, hold on. But like, do you agree? Like, why tell people that this is run in the mill and totally ordinary when it's clearly not?
I don't think anybody's saying that.
No, I disagree with you. I think people are putting these fucking charts up. They're saying the average intra-year drawdown is 14%.
No, we're way past that.
No, I am, but not everyone is. And I think whether or not you're way past that probably is a function of what your investment strategy is. If you're a Vanguard only, stay the course, never do anything, then you're still putting those charts up. And if you have a brain in your head and that's your strategy, you shut your mouth. If you can't stop talking and you're a chimpanzee crashing your symbols together on fucking LinkedIn or on Twitter all day, you're telling people this is normal, and it totally isn't. It's completely abnormal.
So I don't want to pretend that I saw this coming because I definitely didn't. I was not like this is going to pass. I was the opposite. I was in the Bill Ackman camp. So Bill's been tweeting, and somebody said, good job speaking out, but it seems like you should have foreseen the chaos. And he said, I don't think this was foreseeable. I assumed economic rationality would be paramount. My bad. And that's where I was. I don't want to pretend like I saw that. I thought that
not about being foreseeable. It's acknowledging the current situation as it unfolds. It's different than it's different than saying, oh, on January 1st, everybody should have known that this guy was going to take the economy off the cliff to make a point or something. Like, that's not foreseeable, of course, because who would do this?
But even before Liberation Day, I didn't think that he was going to pull the trigger. Like, there was, the analogy that I gave is there was a red button on his desk that said push to detonate the economy, and he did it. I didn't think he was going to push it.
Still time. 5:06 East Coast, midnight.
Still time for what?
Midnight, the reciprocal tariffs take effect.
So we could say two things. Number one, this is not normal. This is not fun. This is not cool. It can also...
Hold on, let me address something. Tyler Dredd.
Dude, could you fucking listen to me?
This is important. Trump has been talking about tariffs all during the campaign trail. Correct. And the number being floated was 10% tariffs and geographic carve-outs and sectoral carve-outs. That's not the same as 38% tariffs on Europe.
What about 104? John, can we play that video? Tee that up.
Ed, go ahead. As promised.
Yes, thank you. You mentioned the 70 countries or so. I'm curious, though, under what conditions at this point would President Trump talk to President Xi about tariffs?
Look, I just spoke to the president about this, and he believes that China wants to make a deal with the United States. He believes China has to make a deal with the United States. It was a mistake for China to retaliate. The president, when America is punched, he punches back harder. That's why there will be 104% tariffs going into effect on China tonight at midnight. But the president believes that Xi and China want to make a deal. They just don't know how to get that started. And the president also wanted me to tell all of you that if China reaches out to make a deal, he'll be incredibly gracious, but he's going to do what's best for the American people.
Okay, so he was not
when
running.
When does she write her tell-all book?
He was not running on 104% tariffs to China.
Of course
not.
not.
Obviously, nobody would have voted.
Obviously.
So okay, so we could say two things. Number one, this is all shitty. It can also be, with the benefit of hindsight, a wonderful opportunity, not to minimize the carnage, for people that have the intestinal fortitude to stay sober, because this is a panic moment. People are panicking. Chart on, please. Over the past 4 days, the S&P 500 lost 12%, and it could have been way worse if we didn't have that bounce yesterday. So there is full-on liquidation. Bespoke tweeted just the fourth time, this was last week, just the fourth time since 1952 when the 5-day trading week began that we had a 10% 2-day drop so far for the S&P. 87, 08, 2020, 2025. This shit is serious. It's one for the record books.
Yeah. And what's so insane about it is this is before the economy really exhibits any of the effects of this. Like, we just got a jobs report for March. That was all things considered a pretty good report. The only layoffs of note were government. Like we did not. This is not a situation where like things went bad and then the market reacted. This is totally the opposite.
Yeah.
And the best way I heard it put today was Goldman Sachs says right now we're in an event-driven bear market that is soon to tip into a cyclical bear market. They mean cyclical in the sense that the economic cycle. So it's not yet an economic bear market. It's all of this is happening. You come in, no worries. I'm just talking to my friends. All right. So that's the difference between this and those other episodes you cite. The stuff from outside of 87, the stuff from November 2008, economy was already in a massive recession. And then that crash coincided with like Congress failing to act in October, and then all the after effects of that. Even once they finally passed TARP, like the damage was already done. It was too late. Nothing's happened yet.
So for people who hear that and say, well, then why in the world would I own stocks today? I would say two things. Number one, the stock market on average bottoms 5 months before GDP does.
Yeah.
Right? Stocks are a discounting mechanism. So 5 months before GDP does. To the point about we haven't even seen the hard data start to roll. We're going to see lower earnings. There's almost no doubt about that. The S&P also bottoms on average, and we have a chart for that we'll use in TCAF, 9 months before earnings per share does. 9 full months. Right. So think back to 2020.
And that's an average, meaning it could be even earlier.
Think back to 2020. The stock market bottomed in 12 trading sessions. And on the way up, and when we made new highs in names like Hyatt and Hilton or whatever the names were, I can't even remember at this point. You were like, or I was like, this doesn't make any fucking sense. Am I smoking dust? You're telling me that these companies are better today, in a better position today than they were in 2019? How? And the whole way up, people were fighting it because the market fell 35%. It saw it coming. We knew. So the question now is, how much has the market discounted? We don't know. Obviously, we'll find out, but Nvidia's down 40%. Like, there is wipeouts everywhere. So throw these charts on. This is stale stuff. This is S&P 500 new lows. I think I pulled this on Friday. So new lows are spiking, whether you're looking at 1, 3, 6, 12 month.
It's worse today.
It's way worse. Breadth, forget about it. No stocks are above any moving average, okay? This is all zero. So we know the market gets the memo very quickly. And this idea that you are going to wait for the economic dust to settle, like, again, think about 2020. It's not to say it's going to play out exactly the same, but it doesn't wait. It doesn't let you back in.
Yeah, and what will end up happening, and we've talked about this before, and this is what the bears hate the most. As things are getting worse, the stock market begins to look through it, and that's the moment where you're like, wait, am I taking crazy pills? Did they see that jobs report this morning? Did they see that PMI?
Oh, Dow rallies on blah 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 blah.
Right,
yeah, that's how it happens.
So it's very frustrating when you get out and then the market runs away from you, and then you're forced to buy back in higher, and it's really hard for people to do.
Because the news is getting worse.
That's a really good argument for not throwing out all your stock exposure, of course. Another really good argument is that it's not a guarantee that in a recession, all sectors in the market will be treated equally. And we've seen the consumer staples get to a 21 forward multiple. Consumer staples are now more expensive than almost any other sector of stock. The other phenomenon that's worth discussing, and I suppose it's possible, is that some of the things that are happening now could really easily be undone, because doesn't require an act of Congress. It's the mind of one man who decides he's made his point or he wants to move on to the next thing.
Yesterday was a dress rehearsal. We saw what happens. On the fake headline, there was a 7% rally in 20 minutes. So we saw how that's going to play out. Right. All right, here's a great data point from Jonathan Harrier. 62% of S&P 500 holdings are at a 50-day low. This is a wipeout. Crossing above the 60 level is rare, happening only 15 times in the past 20 years. Then he goes on to show this is not like by any stretch of the imagination, like a good thing that forward returns are all of a sudden going to rise. He says like volatility is here to stay. When you see this type of action, it's mixed in the short term. How are investors behaving? Well, it depends which investors you're talking about. Vanguard investors, Josh, who you just mentioned earlier, VOO, which is Vanguard's S&P 500 ETF. This is from Balchunas. Took in cash every day last week. Every day, for a total of $3.3 billion, which is almost double its record pace set last year. Not necessarily surprising, though, because this is what happens every sell-off, but still amazing. You simply can't scare them.
Well, these people who are making these purchases, assuming
resolute.
Yeah, assuming they're not day trading VOO, which I doubt they are, these people will be very rewarded someday. And the key is you have to not care when that someday is.
Right.
You have to be okay with that someday being next January.
And 20% lower or worse.
Right. It's if that's the route that you're going down, I'm dollar cost averaging. I'm adding even more to my account when markets fall. I have a long time horizon and I simply don't care. You will win. There's no question. The only question is how much pain you have to go through and how much time.
So I am one of those people. I had some money in fixed income for this very purpose, like whenever there was an opportunity. And am I early? Yeah, probably. But I don't care. This is my rule. When there's a panic, I buy. I have no choice. That is like I saw
that email you sent to your fixed income manager. It was really funny. You're like, give me my cash.
No, what I said was, when there's a market crash, I buy. That's my policy in reference to Naked Gun. But I needed the cash. I'm out.
Is the 10-year falling because everybody's pulling money out of bonds so they can?
You mean rising?
They can buy stock.
Excuse me. Rising?
Is the 10-year rate falling and the 10-year rising and the 10-year bond falling because sellers want a dollar cost average into stocks? Well, like you?
I think that's wishful thinking. Okay, so check this out. This is from Jay Capel. This is a chart that shows all the dates when the fear and greed model was at 3 or lower. I don't know what's in there exactly, but this is panic. And 3 months later, the win rate, meaning higher prices, is 84%. 6 months.
Wait, what's the blue stochastic?
It's a fear and greed model. I'm sure it's proprietary.
Okay,
whatever.
I see.
6 months later, higher 63% of the time. 1 year later, actually not that great. So interesting. But you know what? You have a long-term time horizon. You're able to withstand pain because I'm not making like a call that this is down, that today is the bottom. Who the hell knows? But when I see fire, I have to run in. Sorry, that's just how I roll. All right, back to back. Let's look at Todd's zone. Back-to-back days of record inverse volume. $30 billion on Friday and over $35 billion yesterday. The massive spike from inverse ETF suggests downside is overcooked in the near term. Again, the key word being the near term, because can we get a relief rally that ultimately fails? 100%. That's what a bear market is. You get all of these rallies that fail, wearing people down. Next chart.
Who's doing this? $35 billion in volume on inverse ETFs, so ETFs that bet against the market.
Yeah.
I mean,
that can't just be like day traders.
No, it's got to be hedge funds, right?
Yeah.
Because these are great vehicles for them if they're trying to accomplish something and not sell long holdings, but hedge themselves.
So
These things work.
So if this morning you were like, stocks up 4%, I call bullshit. I want to like hedge my portfolio. Boom, you nailed that. All right. Okay. So we've shared this from Todd a bunch. Last week it was 12 to 1. I'm sorry, a couple of weeks ago. Then last week on the show we shared it was 7 to 1. And when I say 7 to 1, now it's 4.5 to 1. What I'm talking about is the AUM of levered trades that go up with the market versus the inverse. So at the peak, just a couple of weeks ago when it was all animal spirits, it was 12 to 1. Now it's down to 4.5 to 1. My point is, in the short term, as Todd mentioned, sentiment is all the way washed out. He has another chart showing flows into...
Back. This is the mother of all buy signals if we get it.
If they cross?
If we have more ETF assets in levered inverse short, levered inverse ETFs versus levered long, if we even get, I'm going to say, if we even get within spitting distance, you don't need another signal. Only watch this.
So, yeah, I will sell my kids and put the money into the market if that happens.
Like, literally, that's all you need. You don't need to see anything else.
So I will also say, listen, everyone has their own risk tolerance, okay? Like, this is not, I'm not telling you to pile in because I don't know if the next 20% is lower or higher. But for me, when I see panic, I have to buy and we'll see how it works out. All right, people are rushing to cash. He has a chart showing the Treasury bill ETF flows, 10-day sum and 65-day sum, and we are seeing very elevated readings. And this is what happens in a panic. People panic.
Yeah, I'm not sure if there's any real takeaway from like Treasury bill ETF flows because as we've learned over the last few years, like people put money into T-bills or into money markets for reasons that are indifferent. You know, now I know this time there's an obvious correlation. Okay. Stocks are crashing. People buying T-bills, but like people aren't necessarily going to pull money out of those to chase a stock market rally. We've seen that money be really sticky.
Yeah.
Right. So like that's one of the big lessons everybody has learned from the recent past. But the rush is real, obviously.
Yeah.
The rush is definitely real.
And I think over the weekend I was like, I'm a little bit nervous. I'm not feeling nervous. Sunday night I was feeling nervous.
You got the Sundays. You got the Sunday scaries.
I got the Sunday scaries.
They closed. They closed the Nasdaq green yesterday.
Yeah.
Not the S&P, not the Dow. I thought that was interesting. Today was one of the all-time worst. I was on CNBC today. The market was up 1,000. By the time the show ended, the market was up 700. And I looked over at Judge and I said, "This thing's cooked." Like they couldn't hold 1,000-point rally for more than 3 hours. That's like super telling that they're still hanging on these headlines and these breathless breaking news reports. So this is what a bear market does, by the way. It tricks you and fools you so many times. There's so many mirages and false oases. Oases. What's a plural of oasis? Is there one? Oasi? No fucking way.
All right, so let's talk about.
Anyway, it's always a mirage. The point is, it's a mirage. Just don't stop. Step one, you're in the hole. Stop chasing the mirage. It's not going well. It's not going well. All right, go ahead.
All right, let's talk about tariffs. Like, why? So, I think this is the thing, and tariffs were never a partisan issue. It was always an agreement from economists on both sides of the aisle that tariffs are a negative sum game. They lead to less demand. They lead to trade wars.
Yeah.
You tariff me, I'm going to tariff you. It is a tax. It is simply a tax.
In a prior episode, I very clearly explained the first time Trump ever on record in the media was talking about tariffs was on the heels of losing an auction for the piano from Casablanca. And the buyer, this is late 80s, the buyer was a Japanese billionaire who swooped in at the last minute and outbid him. And he went on with Diane Sawyer, and he did this entire rant about how Japan is kicking our ass and we need to tariff. This is a 40-year obsession. He does not hide that. He said, I've been obsessed with this for 40 years. So to the answer, why tariffs? It's because tariffs.
Yeah.
That's it.
You were talking with Steve yesterday. I think you made a good point that if there was a more targeted, measured approach for our national security, vital interests that we need, that we can't be reliant on the rest of the world in the event of a COVID type shutdown, I think most people would say, yeah, fine.
Everybody. Biden passed the CHIPS Act.
Yeah.
Both parties, every age group, every demographic. We need to make semiconductors here, and we need to write policies that stop other countries from undercutting us. Everybody would say, you're right. You're right. Can you say the same for Air Force Ones? Probably not. So I totally agree.
It's the blanket tariff. It's terrible. So Roger Lowenstein said in his Substack, using tariffs to eliminate the trade deficit will risk undermining American strengths. Talk about a cure that is worse than the disease. Far from being ripped off, Americans benefit from importing cheaper and or better goods, which enhance our quality of life in myriad ways. Moreover, trade is part of a circular movement, not only of goods, but also of money. The U.S. trade deficit of $918 billion last year was the mirror image of a $918 billion capital surplus, or infusion from investors. Sooner or later, all of the net $918 billion that Americans spent on foreign goods was invested in American capital assets, such as stocks, real estate, bonds, or short-term assets, such as treasury bills. Alas, Trump has not read Updike. Neither have I, for the record.
You're talking to the wall.
I know.
There's no point. There's half. Look, no. I come from the school where nobody ever learns anything the easy way, and you know that. I've said that many times about a whole range of subjects. This is just one of those examples where, unfortunately, you're not going to get through to anyone until they learn, and they'll learn. I don't think the majority of Trump voters are excited to go work in factories and mines. I don't believe it. I think the rural Trump voter that is not a farmer but maybe lives in a community that's sustained by agriculture, they're gonna have to go through this. I really don't know how else to put it. But I could promise you this: people from Wall Street are not gonna have any impact on this dialogue. So, like now you've heard from Larry Fink. He's a New York Jew that manages money. Nobody's listening. Ken Langone is an Italian guy with a New York accent. Nobody gives a shit. Like, this is the reality of the situation, and we all unfortunately are going to have to go through this lesson together. And listen, it's America. 54% of American adults between the age of 16 and 75 are reading at a 6th grade level or below. That's more than half the country effectively is not going to bother to spend any time trying to actually understand or figure anything out. And that's both parties. That's not like that's not a north-south thing. It's not a red-blue thing. This is just the state of where we are. And so it's a lot of people flicking their phones up and down, scrolling TikTok, and they're going to have to learn. And we have to sit here and watch. And I don't know. Look, the only way this ends is if Congress decides that they're going to step in and say, this is unconstitutional and we're putting a stop to it. But you need people from both parties and not just Rand Paul, who nobody listens to. You need influential Republican Congress people to listen to their constituents who are feeling the pain from this, Republican and Democrat, and just decide, you know what, we're going to block this. This is not legal. It's not constitutional. It's not productive. But it's not enough pain yet. We haven't gotten there.
We were looking at $280 a share for the S&P 500. Let's say that falls, I don't know, 15%. All right, so 280. Doing math, it's dangerous. So that gets you to 240-ish. And let's say we were trading at what, 22 times earnings? Yeah. Let's say we say, all right, you know what, not feeling too groovy about these earnings. 16 times, that gets you to $3,800 or $3,800 on the S&P. It's not inconceivable if this shit doesn't relent.
Typical recession, you wipe out between 20 and 30% of earnings. And
no, I don't think it's that high.
Yeah,
I saw different numbers. 20 to 30% of earnings?
In a recession. Not in an earnings recession, in an actual recession.
Okay.
You wipe out 20 to 30% of earnings. But the worst news is what happens to the multiple. You bottom at 14 times earnings. If I told you what a 30% earnings wipeout from today's estimates for the next 4 quarters combined with a 14 multiple looks like, you would not want to know where the S&P is.
And this idea that it's only the rich that care about the market, it couldn't be further from the truth. It's literally backward.
Stupid.
These people are acting like it's only the rich that own stocks. 60% of the country owns stocks.
Yeah.
Who do you think could weather a storm?
100% of the country. 100% of the country has a job where they work for someone who is very much guided by how stocks are doing.
So maybe I'm in the denial phase of grief. But this idea that people are not just we're going to just let this happen, that the rats aren't going to scurry off the ship, that we're just going to tank earnings 30%, I don't buy it.
I don't think it has to get that bad because, again, it's not a natural disaster. It's not a war.
Yeah, we could just stop.
Metaphorically, it's a war, but
we
it's
could
not.
Just stop.
Correct. This is not people on the battlefield blowing each other up. This is not an earthquake just took out a major U.S. city. Like, I managed money through the Twin Towers being blown up like 3 miles from where I was sitting. Like, I've been through way worse than this. So I agree with you. I don't actually think that we're going to have to go through a massive recession and just to make the stop. I do think Congress will step in sooner.
I think,
and they're the only ones that can. And they're the only ones that can.
So in order to avoid sounding like a broken record, what would I have to see? What would you have to see? What would I have to see to change my mind in that? Oh, he's not looking to negotiate.
Well, no, they're saying he wants to negotiate. They're
he's
actually
saying that. So I think he's negotiating. I think this is a terrible execution.
Everyone agrees.
So
everyone agrees. Even these red-pilled venture capitalists that are that have spent the last 6 months cheering him on, they've all turned. Elon Musk has turned. His brother Kimball Musk is just lacerating Peter Navarro right now. Again, Larry Fink spoke out. Ken Langone, Jamie Dimon will be on the J.P. Morgan earnings call on Friday. I highly doubt he's going to be able to make it through that call without having some stuff to say about this. So that part of it has already started to turn. The thing that has to take place to end this, Congress has to be more afraid of their voters than they are of Trump. Right now, Republicans in the Senate and in the House are terrified of Trump and somewhat scared of their voters. When that flips and they realize they have more to lose by pissing their voters off longer and they're no longer afraid of the White House to the extent they are today, then you're going to see this stuff end up in the courts and get blocked and get halted. But I think we're far away from that.
So his approval rating,
it's not there yet.
It's not crashing. It's early. I mean, the tariffs haven't even started. They start tomorrow.
Dude, it hasn't even happened.
It hasn't even started yet. Right. Anything else to say on this topic?
What's this iPhone stuff that you wanted to do?
Gosh dang it! The screen is freezing. All right, let me jump over here. Okay.
Put this up.
Let me go. Here we go, John. Forgive me. Okay. This is from the Wall Street Journal. Take a look at this iPhone 16 Pro. Your cost for the 256 gig version is $1,100. the cost of all the hardware inside, the bill of materials, was about $550 to Apple when the iPhone was introduced. And now they're saying that the new tariffs are going to take that from $550 up to $846. Apple is not just going to absorb all of that and see their margins on hardware go from 45% down to whatever percentage it would be.
No.
It doesn't work like that.
Yeah. So the argument, the argument coming from the tariff camp is this is the problem. This is the root of the problem. It's not a symptom of the problem. We should be able to make these things more efficiently than we are.
Just do
but
it.
We gave up trying. We don't have people in this country working on this. We don't have the modern factories, and we're not even trying to make the iPhone cheaper. But if we hadn't given up on manufacturing and outsourced it to Asia for the last 30 years, we would be able to make an iPhone for cheaper. I'm not saying they're totally wrong or that I'm just saying that's what they would say back to this idea of the $3,000 iPhone.
So this afternoon, what really got the reversal underway, and Apple's been under pressure this entire week, rightfully so. White House, Trump believes U.S. has capability to make iPhones, and this just destroyed the stock that was already getting destroyed. Over the last 4 days, Apple has lost 23%. This chart is a bit stale. It's 23%.
Yeah.
So 23% in the last 4 days, that is worse than the great financial crisis. It is worse than anything since the dot-com bubble. The stock is in a 34% drawdown. So to the point that I made earlier about stocks being forward-looking, does Apple deserve to be down 34%? Yeah, probably. It happens in 2 seconds. And so I actually bought Apple at the close. I can't tell you the last time I've owned a stock, but it is pure panic. Pure panic. Here's Gene Munster. He said over the past 5 trading days, Apple investors have slid into panic mode. Shares are down 23% since April 2nd. It's going to get ugly with China over the next month, which will intensify the panic. My eyes are on the horizon. Looking out 3 months from now, I believe Apple will be largely spared from the impact of tariffs, given Cook's favorable relationship with Trump and Xi. The biggest wild card is the broader consumer, which could weaken in a recession. That risk, in my view, is already priced in.
Apple's in the eye of the storm, though.
Oh, yeah.
And we did this on a show a few months ago. We talked about how, like, of all the large cap tech stocks, this one and Tesla would be the most susceptible to a trade war with China. And that ended up being exactly how it played out. They are easily the 2 worst of the Mag 7.
Everything that they do, not everything, I'm not an Apple expert, but most of it is manufactured in China. So yes, they move things to India, but that's just cobbling the pieces together. All of their manufacturing components are done for the most part in China. Ben Thompson wrote this last fall. Go ahead.
Well, I was going to say it's their second largest iPhone market. And unlike 2018, yes, there were competitor phone companies, but nowhere near as powerful phones and nowhere near as good at reaching the consumer as the domestic phone competitors are today. So that's their number 2 market that they sell into, not for long, I would tell you. And then they're manufacturing there. So not only do they rely on the Chinese consumer not going all jingoistic and boycotting American products and responding to Trump by saying F you to the next iPhone upgrade, but we also need to have so many of the components to come from there.
So my thesis is that there will be a resolution somewhere. And if I'm wrong and this shit lasts, Apple would be down 60% from its highs. Do you agree?
Yeah,
If this stays on,
it was
Apple
so
is
expensive. It was so expensive in January. It was one of the most expensive large cap stocks. I think it was 38 times earnings at one point.
And itself was never traded
And it had zero growth, and it had zero sales growth. It was a replacement value business.
Yeah.
The stock had been rallying on improving margins as more and more of the revenue was on the services side and not the device side.
And they were getting the benefit of how they're actually not spending that much on AI. That was part of the story.
Here's Wall Street. Apple price target cut today to 170 from 200. Reiterated underweighted KeyBank. Lower valuation multiple. Data points paired with weaker commentary on upgrades from the carriers suggest a miss on iPhone, while we also expect a miss on iPad and a beat on Mac. The impacts of higher costs could be offset by higher average selling prices, but that would impact demand. So there's almost no way out. Here's Goldman. Apple price target cut 242 from 294. reiterated buy at Goldman. We reduce estimates for
love
Apple
those.
to better reflect the net impact of the U.S. reciprocal tariffs through lower margins and lower revenue. In the near term, we expect these costs to be primarily borne by company margins, and as a result, now forecast fiscal year earnings estimates that are below guidance. Last one. Oh, that's it. That's enough. This stock's in the hurricane.
Yeah.
They're in the eye of the storm. There's no way around it. And I do agree with you. If and when there's some sort of a resolution,
Up
you're going to want to be
15%.
long. You're going to want to be long the stock.
All right, here's what Ben Thompson wrote. This is really important because it's not just about Apple. He said Apple can not only not manufacture an iPhone in the US because of cost, it also can't do so because of capability. That capability is downstream of an ecosystem that has developed in Asia and the long learning curve that China has traveled and that the US has abandoned. Ultimately, though, the benefit to Apple has been profound. The company has the best supply chain in the world centered in China that gives it the capability to build computers on an unimaginable scale with maximum quality for not that much money at all. Lastly, here's the coup de grace. This benefit has extended to every tech company, whether they make their own hardware or not. Software has to run on something, whether that be servers or computers or phones. Hardware is software's most essential component. And so if Apple goes down, everybody goes down.
Yeah, and,
That's me, not him.
And Foxconn, which is a huge manufacturing concern in Asia, they rely very heavily on Apple for their own revenue, and they are a huge employer there. So it's not like nobody gets hurt here on the other side, which is, and I think, look, I don't know if this transcends the Trump situation, but I think Tim Cook has a great relationship with the Chinese. He's keeping his mouth shut right now. I think he has no choice. If you had to be any CEO in the world, I think he's the one that you would least rather have his cards, because the needle that he has to thread it seems almost impossible. They can't raise prices on all their products because that's politically fraught also. You think that'll escape the eye of Sauron if they start selling iPhones for $1,900? That might actually be an even worse situation for them.
Do you think Buffett's boys are buying again?
No. All right. Here's what I think is the biggest risk to the market going forward from here. Imagine there is no guidance, and I don't mean to paraphrase John Lennon. Like imagine. So we're gonna get earnings reports starting Thursday for the season. We're gonna get the banks first. And just think about an environment where everybody pulls their earnings guidance. Now, paradoxically, I think the banks are the least likely to pull their guidance because I think they have a pretty firm handle on what they'll earn given prevailing rates where they are. They can't forecast the economy better than anyone else. But the big question mark with the banks is how much do they start reserving against potential losses? They're all in the credit card business. They're all in the home loan business, the auto loan business. So that'll be interesting. But I think just generally speaking, this is the next shoe to drop for stocks. If you get 100 S&P 500 conference calls and the net result is they're all pulling their guidance, they refuse to give anyone an outlook. And by the way, how could they? This is problematic for both the multiple and for just the day-to-day trade as that process plays out. And we really haven't seen a big wave of companies pull their guidance together in a really long time. Here's Ed Yardeni. Industry analysts have been lowering their S&P 500 earnings per share estimates, but they remain high at $268.85 and $307 for 2025 and 2026. That 268 would be 9.2% growth and 14.2% for 2026. Those estimates are likely to fall over time, as estimates typically do, since analysts tend to be too optimistic initially. They will fall a lot if Trump tariff turmoil causes a recession. Let's put this first chart up. So basically, it's a really big stretch to believe that estimates can stay where they are. And the only real question is by how much do they have to fall throughout the course of the next year. Ed is saying that forward earnings per share has been flattening out at a current record high of 279. That puts the forward PE at 18.1 based on, this is yesterday's close. So that's pretty high PE given the potential for downside risk here.
Dude, look at that. Just to reiterate, we were at an all-time high in earnings.
All-time high in earnings. Next chart. Earnings season. The analyst consensus expected growth rate for Q1. S&P 500 earnings has dropped sharply since the start of the year. So that would be that blue line at the bottom. That's a really steep drop for Q1, which we're about to get. But he notes the actual results will be better. However, the forward guidance that company managements give analysts is likely to weigh on estimates for the remaining 3 quarters of the year. So it's the uncertainty.
Yeah.
What do you think about my idea that is the next shoe to drop?
I don't know. I don't hate it. I think the problem is you just mentioned it's the uncertainty. This is a confidence game, and
I know.
And
so pulling earnings guidance is at the heart of what causes market uncertainty.
It does not instill more confidence in the future. And when the leaders of these companies have no clarity on what the rules of the game are going to be, they pull back. They go to the sidelines. They stop playing, and if they stop investing, how do you not see a hit to earnings?
Here's Sam Rowe. He's worried about this too. Companies could decline to provide guidance. He's citing David Costin at Goldman Sachs, who wrote on Friday, quote, "We expect during upcoming quarterly earnings calls, fewer companies than usual will provide forward guidance for both Q2 and full year 2025. Typically, 20% of companies provide quarter ahead guidance, while 43% of companies provide full year guidance." So I don't know, does the 20% go to 15%?
Right.
Does the 43 go to 30? This is the problem. And if we were selling at 15 times earnings, I would say, okay, the market could live with that.
Well, but
we're not.
A lot of the rest of the market is. Like the S&P 493 are like, I think it is like close to 15.
Okay.
So we have discounted a lot of shit.
Now, if they pull guidance, the only response you could have as a rational investor is to say, good idea. Because the only thing that's worse than pulling guidance is giving guidance and then looking like an asshole when you disappoint everybody on the next report.
Well, they also have the opportunity to kitchen sink it. So not only might they not put guidance, they might like substantially lower their guidance.
Put up this B of A chart, John. This is also from Sam. It's Bank of America. The number of S&P 500 companies providing guidance plunged in the 2020 period. And that made sense. Why wouldn't they pull their guidance? How could you see that drop off? So that's like kind of what's at risk here is a COVID-style plunge in companies wanting to give anybody any idea of what next quarter will look like. And I think during the pandemic, it was understandable. I think now it's also understandable, but maybe less forgivable. And institutions will just react by saying, okay, trim, sell.
I think what they're going to do, if I had to guess, is they would say, based on current policies as we understand it, this is what would happen if the tariffs stay on. This is what happens if they go down to 10%.
You think they will?
I think they will.
You think they'll do like best case, worst case, maybe?
And if they don't, the sell side certainly will.
The street will.
Yeah.
All right, last thing on earnings. This is Nick Colas. He wrote this today. Our friend Nick Colas from DataTrek. Investor confidence in future corporate earnings is more than twice as important to stock prices as whatever the companies in the S&P 500 actually deliver.
Yes.
Which is why volatility is so high right now. And he says we have a 30% range of possible 2025 earnings between 189 at the low end, 270 at the high end.
Unbelievable.
That creates a 65 percentage point band of S&P fair values because PE multiples could be anywhere from as low as 14 to as high as 22.
Right.
So this is how you rip the confidence out of the market. And he notes it took the S&P 500 8 years to go from an 8 times forward earnings multiple in March of 2009 at the bottom to 18 times in 2017 as investors gradually regained faith in the system. The Fed screwed that up, and in 2018, multiples fell back to 14 times. Then the Fed pivoted in 2019. We got back up to 18 or 19 times. So it's this seesaw, right? It's this. So it took 2 years since Russia invaded Ukraine for the PE and the Fed's rate hiking cycle for the PE to get from 15 up to 21 where it started this year. And now we're watching that confidence erosion on multiples in reverse. And it probably doesn't, honestly, it probably doesn't stop at 18. So that's, why are you bearish? I don't think companies are going to give forward guidance. And I don't think we're as low as we need to be on the multiple to say that we're discounting all the risk.
Yeah.
So it's not that complicated.
But it's also a stock-by-stock basis.
No, it's not.
What do you mean?
It's not in the short term. It's not.
No, agreed.
It's not.
Agreed.
It should be, and it will ultimately be. The market's a weighing machine over time, but in the short term, it's a panic machine.
But I think the market investors are doing a good job of differentiating the massive risk in Apple versus Netflix.
On some days, you see dispersion, and you see them buying things like mortgage companies. I talked about Rocket, which is a recent purchase I made. You see them buying utilities, and then on other days they just sell everything.
Yeah.
Today we sell everything.
All right, let's talk about this. I think that so tweet on from Zaccardi. Johnson Redbook retail sales soared 7% year over year, nearly the highest since December 2022. And he said, tariff front running ? I think that you are going to see some really funky shit in the data over the next couple of weeks and months.
Oh, I agree.
And you're going to see some distortions. Chart off. You might even see some positive distortions, and he might claim victory.
Oh, man, that's going to be a stretch. So, all right. So people racing to build inventory ahead of the tariffs could make it look like the manufacturing renaissance is already at hand.
What if we see a boom? What if we see a boom in iPhone sales because people are buying an iPhone before the tariffs get slapped on? I think it's like rational.
There was an article about that. People racing to buy their iPhones ahead of the tariff. I call it bullshit. No one did that.
What do you mean?
Is there anyone in your life that ran to an Apple store to buy a phone this
Robin
weekend?
literally asked me, what should we be buying?
You should tell her we should be selling. We should be. She has the wrong instinct. So
the ultimate question is, or maybe not the ultimate question, one of the questions that I have is what breaks the back of investors who have learned for 15 years to buy the dip? What does it?
Time. More days like today. So, like a really heartbreaking thing would be like a 3-day rally that then rolls back over onto itself. We haven't really had that yet.
I think it's going to be hard to do it.
We've been straight down, dude. It's happening. There's a lot of investors who weren't around through 2000 to 2002. There are a lot of investors who weren't around from 07 to 09. They really don't know what it's like to be down 6 months straight. It is so debilitating mentally, and it causes a change in behavior. And it hasn't gone on long enough. It's not the depth of the bear market of the correction. That's not the thing. It's the amount of times the rallies fail that change investor behavior, and it's too early.
But I agree. But that's going to take, I think, maybe longer than you think. In 2022, remember there was a stat like we have never seen a 20% decline retrace 50% of that and then roll over to make new lows. Well, we did make new lows.
And then, of course, it did.
We did. And in 2022, there was small outflows on net, but it was all from mutual funds. ETFs buyers did not relent. So I think it's going to take, it's not just going to be one quarter. Now this is different. It's politically driven and people are like really scared. But I think they're going to be more resilient than I think people might think. Like if you're looking for the retail washout to mark the bottom, I don't know if we get that.
Yeah. Yeah, I'm not sure. I'm not sure if I could say yes or no on that. Let's do some flows stuff because I thought this was interesting. Bank of America said every single type of client bought last week. Huge inflows. Last week, the S&P 500 fell 9%. That was the biggest one-week sell-off since October of 2008. Clients were net buyers of $8 billion of U.S. equities. This is just at Merrill Lynch, Bank of America, okay? That's the fourth largest weekly inflow in the history they've been keeping data back to 2008. Clients bought both single stocks and ETFs with inflows across all three size segments. So when they say all client groups, institutional investors had their first inflows in 3 weeks, biggest since December. Private clients, that's regular rich people, have been buyers for 17 weeks straight. Had their 6th largest weekly inflow on record. Wow. Hedge funds were small net buyers for the first time since early February. And even corporate client buybacks came in and started to track above typical seasonal levels for the first time in 5 weeks.
We were talking about that, and you're like, no way. And I was with you. No way is any CFO buying stocks now. I guess they were.
Well, they are, but very tepidly considering the damage to their share price. That should have been a record, and it wasn't. And that tells you how cautious CFOs and treasurers are being. Barclays says that we've seen a significant delevering by quants, not yet by retail. Systematic funds are in the process of substantial deleveraging. The bulk of it is likely done. In contrast, direct retail may have started reducing their equity exposure, but they haven't capitulated. And then last, JP Morgan says massive selling Monday. After historic dip buying by individuals last week and overall bullish activity, retail investors are now net sellers. This is yesterday. They turned bearish on NVIDIA, along with Tesla, and the rest of the Mag 7 except for Alphabet. So maybe that's a sign that retail is beginning to capitulate. I bet you today looked a lot like Monday. What do you think?
Not to be too cute, but sorry, I can't help myself. Speaking of JP Morgan, the famous quote, in a bear market, stocks return to their rightful owners. I really do believe that to be the case.
Okay, so I guess that's Vanguard. I guess that's their rightful owners, because that's where the buying is coming from. All right, we're gonna wrap. We're gonna make the case, and then I'm told you have a mystery chart for me tonight.
I do. You're not gonna get this one.
All right, I think you'll agree. I think you'll agree with this. You could find safety in Microsoft and Netflix right now. Not like pure safety, like they're not going to go down at all. But if you are long only and you must be invested in stocks, I think those are two smart places you can go.
Why do you say Microsoft? Netflix, I would agree with, but why Microsoft? It's rolling over pretty hard.
Here's Martin Peers of let's do the charts on each, and then I'll explain.
Okay.
It looks terrible, but this drawdown is nowhere near the drawdowns that we've seen in other stocks of its ilk, and it didn't really have the run up. Next one, Netflix.
Hold on, just to pause on that, Josh. You're 100% right. Microsoft hasn't done crap in a while, despite the open AI and all that sort of stuff.
This is no big deal, dude.
It's in a 25% drawdown. So
I know.
Not nearly as bad as Nvidia, of course, but not nothing.
Not nothing, which is why I think it could be buyable here. Let's do Netflix
for sure.
This is aside from the fact that this is a head and shoulders and should be avoided at all costs. I think it's a consumer staple. It's in the telecom and it's in the tech, the communication services sector. But I honestly think this is the last thing people cut.
You're 100% right.
Yeah.
Nobody's canceling their Netflix unless we get a depression. I don't know that this matters. It still trades at 35 times forward earnings. So
Morgan Stanley called Netflix its top pick, replacing Disney in the sector for this year. Reiterate overweight, $1,150 target. Quote, we expect Netflix to demonstrate relative resilience in a weaker global macro. Momentum in its core subscription business, combined with recent dollar weakness, should de-risk 2025 estimates, even in a softer ad market.
It's only down 2% this year.
Yeah. The analyst said advertising growth is expected to double in 2025. Ads still remain a small part of the overall business. They're only 10 to 15% of revenue growth, and only 5% of total revenue. But the ad-supported tier strategically will keep people from abandoning their Netflix subscription. 2 hours of daily viewing per member. The engagement is really strong, and that's why nobody cancels. Over 94 billion hours were streamed in the second half of 2024. Plus, they have sports now, which keeps it even more defensive. So I like that idea. Here's Martin Peers on Microsoft. What does he say? Doesn't matter. Microsoft is not caught in the eye of the storm in terms of tariffs. They're not selling iPhones. It's not quite as fraught a political situation as you have with Apple. And it's like a hugely steady cash flow business. It's very heavily reliant on businesses, and businesses are not like throwing away their Microsoft subscriptions just because they have a couple of tough earnings quarters. So I think both of these places are places that you could hide out. What do you think?
Netflix. Yeah, I mean, it's all dependent on whether if the market melts down, everything's going down.
Yeah, no, it's all relative. I'm
But-
saying if you have to own stocks, these are stocks you could wrap your head around right now.
Netflix for sure. It's a consumer staple. Nobody's canceling it. I think the earnings are going to be less volatile than the overall market. What a fucking week, man, huh?
It's Tuesday.
It's Tuesday. It is Tuesday. Okay. Listen, this sucks. It's not fun. But if you are the type of person, and we all are at some point in our lives, have looked at a stock chart and said, I can't believe I didn't buy it. I had the chance. I missed it. Now listen, this might be different. Maybe this is not one of those times. I don't know. I can't see the future.
You're going to show me a stock that you think people are going to turn around.
No, I'm just saying, just in general. Like if you've ever said that to yourself, and we all have, and you're not buying today, then you never get to say it to yourself ever again. I'm sorry.
Okay. I think that's fair. Like, let me get this straight. There's nothing you want to buy? Right. I totally agree.
Yeah, and you could say that, like, yeah, this might not be the optimal price to buy, and everybody's got a different risk tolerance, but like, there's come on, there's opportunities.
I bought some stuff Friday. These are core forever holdings. I bought Chevron. I bought Amazon. I know you bought some Amazon too. I added to Uber. Like, these are stocks that I'll be in years from now.
If you think that cybersecurity, I bought CrowdStrike, is a secular growth story, and of course it is. All right, enough of that. Okay, chart on. Josh, I'm showing you the best performing stock in the S&P 500 year to date. Now, this is
how great is that?
This is a stock. The reason why is because it got just kneecapped. I don't know if it's down 70% or what. It's been a secular loser. But you actually made the case for the stock, and then it got kneecapped again. But nevertheless, you made the case. You were wrong on the short term, right in the long term.
I need one more clue.
Oh, shit. I forgot to make this chart. Do we have the chart of the best 10 stocks and the worst 10 stocks? John, do you have that? I think I sent it to you. Maybe I didn't. There we go. It's in this group, so that's a bit too easy. But
oh, it's in the blue in this group?
Yeah.
Cencora.
Nope.
No. Huh. Okay.
Cencora sounds like the whiskey that Bill Murray drank.
Lockheed?
No.
I don't even know what you're talking about.
It's CVS.
I made the case for CVS. Was I smoking crack?
Remember one of the big hedge fund managers took a long position in there? A big position?
Yeah. Oh, all right. Maybe. I mean, I definitely didn't buy it, and I don't want any credit for it.
Well, nevertheless, it's the best performing stock.
What is this, an $11 stock? I don't even know where. All right. That thing's still publicly traded? That's a miracle. Oh, yeah, there's an activist in it or something.
Yeah.
Right. I didn't buy it. All right. What's a worse stock in the S&P 500? Do we know year to date?
I think it's Deckers.
I would have guessed either tech or apparel or something consumer discretionary. So, what are these? These are the 10 worst. These are the 10 worst stocks since Liberation Day. I don't want to buy any of these.
Bear with me 1 second. No, I'm not. These are not for me. The worst stock year to date. Y charts. It's Western Digital, down 48%, and then actually the same exact amount. Deckers Outdoors. So yeah, nobody's buying Uggs. Why would you?
Yeah, later for that. All right. Hey guys, thanks so much for joining us for the live. We really appreciate it. If you're listening on the podcast, please go ahead and leave us a rating and review. It goes a long way, and it helps signal to everyone else that there's quality here. And we love you for it. Wanted to mention tomorrow is Wednesday, which means an all-new edition of my favorite podcast, Animal Spirits, with Ben Carlson and Michael Batnick.
Dude, Ben needs a hug.
Ben is living in Michigan, which is unfortunately going to be like an epicenter of this trade war stuff, and I think it's affecting a lot of people around him. And least you could do is tune in and listen to him bitch and moan. So that's tomorrow morning. We'll have Ask the Compound later this week, and an all new edition of the Compound and Friends. Plus, we're doing a surprise drop on Thursday. And I think you guys will be super excited about it. So, all right, that's it from us. Have a great night. Stay alive through 25. We'll talk to you soon.